Hello, and welcome to Future Now, the podcast where we discuss new technologies and ideas and how they might affect your future. So today we're talking about blockchain with Francis Mendoza, who is from the Blockchain Innovation Society. He works on what is called the Internet of Things, or IoT, which are the systems that all our wireless technology uses to communicate with each other. This technology has some pretty massive potential when paired with blockchain, which Francis is going to walk us through. So let's go ahead and check it out.
Hi, my name is Francis Mendoza. I'm a rising senior here at Arizona State University. I major in computer science, and I am the longest-standing undergraduate researcher at the ASU Blockchain Research Lab.
And how long has that ASU Blockchain Research Lab been around?
It's been around since the fall of 2017, which is a funny story considering how originally I wanted to go to U of A for college, but I was just delving into blockchain during my high school, and I read an article. It was released by the state press, and it was how ASU and the Dash cryptocurrency was funding an ASU blockchain research lab in the fall of 2017. So, as fate would have it, I would switch schools, change my major to computer science, and the week before I would email Professor Boskovic, who heads the lab, asking if I can join, and he said, of course. And ever since, I've been doing work in the space, and I don't regret it.
In terms of the actual research you do, what does that look like? What kind of space are you working in?
So there are many different applications for blockchain and many different engineering challenges that have to be solved. My work specifically deals with utilizing blockchain technology within the Internet of Things. So basically everything, any interconnected device such as Amazon Alexa to fleets of autonomous drones and self-driving cars, those are technically Internet of Things devices. And what I'm trying to do is essentially bring the transparency and security benefits of the blockchain to basically host these Internet of Things devices. So you have a centralized platform, not centralized, but a standardized platform in order for those devices to talk to each other and exchange data.
What do you mean by a standardized platform?
Nobody wants to really share their data. They all want to keep it siloed under their corporate umbrella, which makes sense because data is how they generate a profit, right? And as much as possible, they want to extend their initial IoT product into eventually a line of IoT products. And here's the limitation with that. So the business logic makes sense, but there's in terms of the limitations of the industry, there's no one industry that's going to be a market dominator in the IoT space. And that's especially significant because, well, unless you somehow manage to evade the wiles of antitrust regulators and have billions of dollars of bankroll, you can't control the IoT space. So the alternative is you get different enterprises who have their own IoT solutions to essentially work together. It's a cyber-physical systems genie. Like society will essentially tell this genie what it wants, and the devices and systems which are owned by different enterprises will essentially work together in order to solve that problem, and whoever participates in solving it gets a cut of the profits.
And that's kind of the philosophy behind blockchain itself, right? It's this idea of cooperation.
Oh yes, absolutely. Yeah. So to delve into the history of blockchain, blockchain was originally devised. Well, it's originally started out with Bitcoin in 2008. An anonymous writer by the name of Satoshi Nakamoto, he publishes the Bitcoin white paper, and basically his frustrations were with the central banking system and our current the limitations of our current financial infrastructure. So basically, as he saw it, the reason why 2008 was able to happen was because you had a bunch of peers not acting within the interest of the entire system, and their actions essentially caused like the 2008 housing crisis. I'm not sure if you're familiar with how the details of those work, but essentially it was like it all stems down to the prisoner's dilemma, if you heard of it. So
I have not. Please tell me.
Oh, so this is a very interesting age-old psychological question. Okay. So imagine that you and I went to jail. All right. So we both committed some sort of crime. Now let's say that the officer says, if we both admit we're guilty, right, to doing the crime, we only get 2 years of prison, right? But if none of us say anything, we essentially get like let's say 5 years. Right, okay. But then here's the catch. So if you say that I did, if you declare yourself innocent and you say that I'm guilty, then essentially you go free, but I have to spend 10 years. And if I declare myself innocent, you declare you guilty, I go free, you get 10 years. But if we both say that we're guilty, I mean, like we accuse each other of doing the crime, we both get life in prison. So the caveat to that is essentially what is good for the individual is not necessarily good for the whole. From a game theory perspective, it is much better off for both of us to just say nothing and just do the 3 years. However, from an individual perspective, my incentive to go scot-free while you get like 10 years in prison, right? Then I mean that's a very tempting incentive, but I have to consider that you might do the same thing. So it's sort of like a conflict of interest. Like, yes, I could say nothing, but if I say nothing, I risk you betraying me, so you go scot-free and I spend 10 years. But if we both betray each other, we'll both get life in prison. So that prisoner's dilemma is essentially what Satoshi believed as the crux of the whole 2008 financial crisis. So he had this critical thought experiment. How can we design a monetary system that essentially incentivizes people to act in the best interest of the group, and that is directly correlated, to their own benefit. So what he did is, now he was a cryptographer and he was a computer expert. So what he did is he designed a Bitcoin cryptocurrency. So unlike your traditional currency, which is controlled by the Federal Reserve, Satoshi essentially believed that was a huge problem, because one of the central cruxes of Bitcoin is that it's a cryptocurrency. It's the world's first currency in which you don't need to trust anyone at all in order for it to function. Whereas in our traditional financial system, you need to essentially trust these custodians of the financial system, the Federal Reserve, other financial institutions, and trust that they're doing the right thing with monetary policy, etc., so that essentially your currency will still be usable. So essentially Bitcoin was released in 2008. The key features of it are essentially it's determined by the market. So the market sets the price. So unlike fiat currency, the US dollar, which is determined by whoever controls it, in this case our Federal Reserve, Bitcoin is directly determined by how many people buy into the system. So by buying in, they place money. And so essentially as more people buy into the system, the value of Bitcoin is directly correlated with that. The other interesting thing about Bitcoin is that there will never be more than 21 million Bitcoin ever. And that's very important, because by having a hard cap, you will not experience essentially problems like, I wouldn't want to say inflation, that's not the technically correct term, but by having a fixed supply, you have a lot more stability in terms of preserving the purchasing power. The currency is designed to be purely digital. That's the first part. And the second part was, you didn't want to peg it to the whim of like some person who controls that currency. It's designed to be of the people and for the people. So it's a trade-off. Essentially, by allowing it to be flexible and letting the market set the price, and not having one person essentially can decide what this is worth and how much of it everyone gets, it's a lot more volatile, and that's an important part of a currency. So volatility is basically how much a fluctuation the value of a currency has, and you typically don't want that in a currency, because how do I know if I wanted to buy bread for $5? How do I know my $5 is still worth $5? That's why people haven't really switched over yet to cryptocurrencies, because the volatility issue is a very big one.
And that came up a few years ago, right? Wasn't there like a big crash or something along those lines?
Oh, absolutely. So the interesting thing about cryptocurrencies is that their life cycles are they're very volatile at the beginning, but once they reach, like with any other network phenomena, they reach a critical mass of adoption. Essentially, their value will stabilize at a certain point. So, and that's the thing that's with blockchain technology as well. So they have this property is, when they start out, they're very vulnerable. So blockchain, which is the technology that supports Bitcoin, is essentially, it's part database, it's part set of cryptographic protocols, it's part it's a distributed storage and computation platform that doesn't rely on any single party or any single person to essentially ensure that the system operates smoothly. So blockchain essentially operates like this. Imagine Google Docs, right? So Google Docs essentially works by having everyone have access to that same document, right? If someone makes a change, everyone gets to see it, right? So blockchain essentially works by, like, imagine, so that Google Doc is essentially a record of all the actions that everyone has ever done on the blockchain network, right? And just like how you can view who wrote what in a Google document, you could essentially do the same with a blockchain. So a blockchain is essentially, you have a bunch of computers, right? And they're all talking to each other. And as they're talking to each other and doing things, they're all storing what they did into like a file that's essentially the history of what everyone has ever done since the beginning of when that network started. And that's extremely important because, one, you can't change the record. So you have perfect accountability of what everyone did, what anyone did at any given time. And if something breaks, you can trace to a amazing level of precision who did what and why. So essentially that's the first benefit of the blockchain network. And with the analogy for Google Docs, essentially this record, everyone who's running on the blockchain protocol has a copy of that record. So it's not like, and you can't change it, because if you try to change it, essentially people will suspect that you're trying to cheat, and then they'll just boot you off the system or not listen to you. So that's essentially an inbuilt security feature of the blockchain. But the other important part of the blockchain is it's not just immutable. So it's like you can't just change the record, but distributed systems, blockchain included, have this interesting property called fault tolerance. So fault tolerance is basically like a certain percentage of the computer nodes in the network at any given time. You have to assume that a certain percentage of them will not act within the best interest of the whole. But the just the fault tolerance is essentially, it doesn't matter how many nodes are not acting within the best interest of the entire system. As long as it's below a certain percentage, essentially the network will continue to function. So that's a very interesting property. So it's sort of, I would say blockchain is essentially an electronic democracy. So it's whoever, like, majority rules. So whatever the majority of the computer nodes on this network say is the proper record, that will be the record. That will be the main version of truth. And even if you have a certain percentage of nodes saying, no, we disagree with that, as long as if it's below a certain percentage, essentially the network will continue to function, and it's not like those guys who are not acting in the best interest will break it. Does that make sense?
Yeah, okay, that's interesting. So it's probably not the word impossible, but it would be very difficult for some sort of, I don't know the right terminology, but essentially for hacking to occur.
Oh, yes. So people have discussed concerns about, is it possible to hack a blockchain? Absolutely. It is possible to hack a blockchain. However, an important thing to note is there's a difference between being theoretically able to hack a blockchain, which it is, and being practically able to hack a blockchain. So if we're talking about, if you want to practically hack a blockchain, you got to do it while it's small, because the one of the interesting properties of blockchain is essentially it gets stronger over time, and it stems from the philosophy that all the nodes are continuously just like adding records. So essentially what you have is that you have like all the data, all the information is packaged into a unit called a block, right? And then you have multiple blocks, and they're chained together by some fancy math function called hash-based cryptography. So you chain those together, and basically you have a chain of blocks. That's why it's called a blockchain. And it's called a blockchain because essentially as you continue to use the network more and more, this blockchain grows longer. And if you want to hack into a blockchain, you have to essentially rewrite the entire history of the blockchain to up until where that transaction, like let's say if you're trying to change this transaction, you have to rewrite the entire history that precedes that transaction in order to make it fit, versus like trying to change one thing at a time. Like if you were trying to change something in a traditional cloud server, all you have to do is just change one record and hope someone doesn't notice. But with a blockchain, you have to rewrite all the records, all the transactions ever since the beginning of when that blockchain was created, within a 10-minute window in order to successfully pull it off. And you have to do it in broad daylight. We know. And you have to do it where everyone can see you, because remember, this is a democratized electronic network. So all these computer nodes are constantly checking for the version of the truth, and if they see that you're trying to rewrite the version of the truth, they'll just boot you from the network. So
you would have to essentially like conscript an army to do it, right? You would have to
essentially,
have just a lot of people. Okay, that's interesting.
So back to the crux of why, yes, theoretically you can hack a blockchain. So you can launch moderately successful attacks when it's small and there's not a lot of peers supporting the network.
Has that ever happened?
Yes, it has.
Okay.
So there are ways to hack the blockchain directly, and there are ways to hack the blockchain not because of the blockchain itself, but through the way it was implemented. So we call these like side channel attacks. So essentially you hear of exchanges being hacked. So essentially you might not be able to hack the blockchain directly, but you could find more success into hacking applications or some sort of side channel.
And then just shifting gears a bit, if we're looking into the future, there were 3 stages of blockchains evolution, and we're only in the first stage, right?
Absolutely. So the 3 stages of blockchain's evolution, so we have blockchain 1.0, 2.0, and 3.0. We haven't yet reached the peak of blockchain 1.0, which primarily deals with cryptocurrencies and financial technology. So essentially the direction that we're starting to see right now is we have 2 camps in blockchain. So we have the first camp, which are made up of like libertarians, I would say like maybe anarchists or like pure Bitcoin maximalists. These are the people who believe that Bitcoin should be essentially, and other cryptocurrency should be this niche tool to essentially have independence away from the contemporary financial institutions. Essentially, they're able to hold a currency that's essentially not controlled by any one party or a person related to the government, and they have absolute freedom of who to get to essentially transact that currency with, etc. And you have the other camp, which is more moderate. So these are the people who are looking to find mass adoption within the blockchain industry. So like, yeah, it's a niche. It started out as this niche tool, but they want everyone to use it because there's utility in like accountability and security aspects of blockchain. Like you can put your company, you can track your company operations on a blockchain or your financial transactions on a blockchain. And essentially what you're like, there's huge benefit in the financial sector because one of the fundamental one of the points of fundamental utility for blockchain is essentially you're able to get rid of the middleman. So it's direct peer-to-peer transaction, and in the business world, there are a lot of intermediaries, especially something like escrow or like compliance officers. With blockchain, you don't really need that anymore because you've basically outsourced the compliance and the management to software, and you can't bribe software. You can't, and everyone will have a complete record of like who's doing what. So there's no conflicts of interest. There's no corruption. Everything happens much faster, and it's a lot cheaper and more efficient in the long run. So there's like a lot of great reasons as to why financial institutions now are actively implementing blockchains, especially banks. Banks haven't really evolved based on from a long time, and they see blockchain as like one of the things that they have to jump on the bandwagon for, or else risk being obsolete because there's just too many efficiency and security benefits from the blockchain that you wouldn't get anywhere else. So we haven't reached peak adoption for blockchain 1.0 because there's still a lot of regulatory issues, and there's still some engineering challenges that need to be resolved, as well as getting a critical mass both the public and other financial institutions to accept it as a standard. So right now, people are just doing pilots and trying it out. But we're now starting to move past that because now we're starting to see some very successful use cases. For example, Ripple. Ripple is essentially a cryptocurrency in which you're able to send remittances from one person to another. It's like when you send money to a relative overseas or something. So typically how it works is that like if you want to send money overseas, you have to pay some fee like to like Western Union, right? Okay. But with Ripple, essentially, because you're essentially getting rid of the middleman, essentially like Western Union or some other company in this case, you're able to charge a lot lower because you don't have the expense of the human capital needed to upkeep that because it's literally just software. So essentially you're able to do that entire thing for cheaper and a lot faster too. So essentially what happens is that consumers get to walk away with, like, if I send like my grandma $100 like she will get almost exactly $100 because like the overhead is so small, whereas if you do that through a contemporary institution, the overhead is a lot larger for that. So we're starting to see use cases. It's not just Ripple, but there's a bunch of successful use cases that are starting to come out, and the ones that don't have value are starting to get weeded out over time. So that's blockchain 1.0. Blockchain 2.0 is primarily about smart infrastructure, smart cities, the application of essentially just like smart property and smart assets in general. And that's where IoT really comes into the picture. And that's really my line of work. And then blockchain 3.0 is primarily concerned about actually overhauling traditional institutions from the ground up. So they are more democratized by nature, and they're running on this blockchain. So there is more accountability. There's more accountability, there's more security, and there's more cooperability because now you have a shared set of standards that's essentially electronic. Because like essentially what happens is that it's supposed, like Bitcoin and blockchain, is supposed to be a peerless, borderless technology in which, as long as it doesn't matter what your political affiliations are or like what government structure like your home country is, like if you adopt a set of standards, essentially you're able to interact with people like from the other side of the world in terms of like financial services, cooperation, etc. So an example of something like that would be blockchain-based voting. So essentially I see a future in which you can literally put votes on the blockchain. And remember that whole immutable record thing? You can literally have a cluster of computers actively check the voting history, like the voting history of who voted for what, right? And make sure that those votes are accurate and there's not like a person tampering with the results of those votes. And that's very important for democracy. Transparency and accountability are basically very important pillars for democracy, and blockchain is a quintessential technology in order to assist that.
So there's a lot of great things, it seems, about blockchain moving forward. Is there any potential for consequences or negative things coming out of implementing this kind of technology?
Negative consequences, I would say, come from their implementation. So right now, a problem with the Bitcoin blockchain is that the people who have the most money are the ones that are more inclined to control the cryptocurrency, which is ironic considering how the entire purpose of it was to ensure that you have a fair, balanced cryptocurrency that's owned by the people and it's not really centered around any one party. So you see a lot of, I would say, 60% of the Bitcoin nodes are actually centered in China. So essentially, this presents a centralization problem because the architecture was designed so that people around the world would essentially set up their own Bitcoin node and be able to, receive and transact and mine their own Bitcoin. But it appears that one of the weaknesses in implementation is that if you have more capital, you have the ability to get more nodes, and therefore you have control over a lot of the supply. So essentially, what I would say sociological or economic attack that they figured out is that essentially you have these things called Bitcoin whales. So Bitcoin whales are essentially a small minority of people who own a lot of the cryptocurrency. And remember how I said market controls the price? So essentially their behavior, whether it's buying or selling, will have a huge impact onto the fluctuation of that price. So a typical strategy is that a whale would or a group of whales essentially they would essentially try to short their holdings. So shorting is essentially when you sell whatever asset you have, so then it incites a panic, fear, uncertainty, doubt, so that the price goes down, so then you can buy back in. So essentially, with the same amount of money that you had, you get more of that asset. So I've seen whales try the shorting tactic over and over again, and especially if they had the money to begin with in order to mine the cryptocurrency or to buy it outright from an exchange, they directly affected the price and the valuation of that. And essentially what happens is that those people who had weak hands in this industry, now you had the transfer of wealth from those who were able to hold and from those who were who didn't have a lot of who had weak hands in the cryptocurrency to begin with. So we're starting to see an inadvertent transfer of wealth, but that's purely from an implementation standpoint. It's really a genius system because if you're acting within against the best interest of the network, no matter what you do, people always have the option to opt out, and really it's the decision of the overwhelming majority that gets to decide what, essentially the fate of that blockchain network or that cryptocurrency or whatever is hosted on it.
Before we end, is there anything else about this subject, anything at all you want to throw out there or add?
Blockchain. This is a very we're living in a very interesting time because essentially this is basically like the 90s. This is like the 90s when it comes to the internet. So essentially, to draw parallels, there is this very slow build-up, a lot of experimentation. There's a lot of enterprises that come and go, but then at a certain point, it starts to boom in a sense in which now you're starting to reach mass adoption. So the history before was that there's always a hype cycle when it comes to any new technology. So what would essentially happened was, back in 2017, Bitcoin reached December 2017. It reached around 18K, right? And people were so hyped that was the next big thing. But what you had was a bunch of people investing in a technology they did not understand. So to reiterate again for everyone out there, blockchain is essentially it's a new computing paradigm. It's a new storage paradigm, and it's also a business transaction paradigm. But instead of just transacting with a middleman in between your transactions, now you're able to interact directly with the person you want to talk to without any intermediary at all. So it's not controlled by anyone. The blockchain network is essentially controlled by you, the people who are actively using the network. The users are the owners. There's no one person who is too powerful, and essentially there is accountability, trust, and security throughout this network. So that's essentially what blockchain is. And in terms of the history so far, so people got super hyped in December 2017, and of course that was a bubble. It popped. People became disappointed. Investors became disillusioned, and now we were in this period of a long crypto winter. So that happened. We had that exact same period in the 90s with the internet. So people invested in .coms, and then that bubble bust. And then essentially what's happening now is that we're starting to see this great culling period of all these projects that don't have value. So the ones that don't have value will essentially get wiped from the marketplace, and the ones who do have value, they'll stay, and essentially they will become the next blockchain barons. They will become the blockchain barons of this age. Those use cases are the Amazons, the Googles, the Facebooks of the blockchain era. So now, within the, I would say, less than 5 years, we're going to see the use cases and the companies that we will probably start to use on an everyday basis, but they're built on the blockchain. So it's a very exciting time. It's not too late to join, and I would, if anything, since we're not even past blockchain 1.0, we're still just getting started, and it's a very exciting future, and I can't wait to see what it holds.
That's Francis Mendoza from the Blockchain Innovation Society sharing the future of blockchain and the Internet of Things. We are in stage 1 of a 3-stage development of blockchain technology, and so the future still has so much to tell, from cryptocurrency to smart cities. And for the State Press, I am Balin Overstolz-McNair.